Imagine this for a moment. 10 years ago, you made a simple decision. Instead of chasing quick money, day trading, or jumping on every hot investment trend, you chose to follow Warren Buffett's advice. No hype, no risky bets, just simple, long-term investing principles. Fast forward to today. While others were constantly guessing the market, your money quietly grew in the background. Market crashes didn't scare you, and your investments kept compounding year after year. So, what would really happen if someone followed Buffett's advice for 10 years straight? Let's find out. Warren Buffett's most famous rule about investing is surprisingly simple. He often says, rule number 1, never lose money. Rule number 2, never forget rule number 1. Of course, Buffett knows that every investor will experience losses at some point. Markets go up and down, and no strategy is perfect. What he really means is that investors should avoid unnecessary risks and focus on protecting their capital. Imagine that 10 years ago you decided to take this rule seriously. Instead of chasing speculative stocks, trendy investments, or companies that promise quick profits, you focus on businesses with strong fundamentals. These are companies that have reliable earnings, strong brands, and a long history of success. For example, many long-term investors choose companies like Apple, Coca-Cola, or Microsoft, businesses that dominate their industries and continue growing over time. Another simple option Buffett often recommends is investing in a low-cost index fund that tracks the S&P 500, allowing you to own a small part of hundreds of strong companies at once. These investments may not feel exciting or dramatic, but they are built on stable, proven foundations. By avoiding risky speculation and focusing on quality businesses, you create a portfolio that is designed to survive market ups and downs while steadily growing over the long term. Another core idea Warren Buffett strongly believes in is consistency. He often explains that successful investing is not about perfectly timing the market or predicting every rise and fall. Instead, long-term success usually comes from steady, disciplined investing over time. Imagine that 10 years ago you decided to invest $500 every single month. That equals about $6,000 per year. Rather than worrying about market news or trying to guess the best moment to buy, you simply invest regularly into a broad market index fund like the S&P 500. Over 10 years, you would have invested $60,000 in total. If your investments earned an average return of around 10% per year, which is close to the historical performance of the S&P 500, your portfolio could grow to more than $100,000. This growth may seem surprising, but it's driven by compound interest, where your profits begin generating additional profits. By investing consistently and staying patient, you allow time and compounding to become your most powerful financial advantage. During any 10-year period, the stock market almost always experiences a major drop. Prices may fall sharply, headlines predict disaster, and many investors panic. But Warren Buffett views these moments differently. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." In simple terms, when everyone is panicking, opportunities appear. If you followed Buffett's mindset for 10 years, a market crash would not scare you out of investing. Instead, you would continue buying quality companies at lower prices. Think of it like a sale at your favorite store. The products didn't become worse, they simply became cheaper. By staying calm during downturns and continuing to invest, you position yourself to benefit when the market eventually recovers. Another surprising lesson Warren Buffett strongly believes in has nothing to do with the stock market. Despite being worth over $100 billion, Buffett still lives in the same house he bought in 1958. This reflects a powerful principle. Building wealth is often about spending wisely, not just investing. If you followed Buffett's philosophy for 10 years, you would likely focus on living below your means. Instead of upgrading your lifestyle every time your income increases, you would invest the extra money. This might mean driving a reliable car longer, avoiding unnecessary luxury spending, and prioritizing financial security over social status. Over time, these small choices make a massive difference. The money that could have been spent on short-term pleasures instead becomes long-term investments that continue growing year after year. Buffett doesn't see stocks as quick trades. He sees them as ownership in real businesses. He once said, "Our favorite holding period is forever." If you followed this idea for 10 years, your mindset towards investing would completely change. Instead of reacting to daily price movements, you would focus on the long-term success of the companies you invest in. You would ask questions like, is this business strong? Does it have loyal customers? Can it grow over the next decade? By thinking like a business owner rather than a trader, you avoid emotional decisions driven by fear or excitement. This long-term perspective reduces stress and allows your investments to grow naturally over time. Patience becomes one of your most valuable financial tools. Albert Einstein reportedly called compound interest the eighth wonder of the world, and Warren Buffett's entire fortune reflects its power. Buffett started investing when he was just a child, but most of his wealth came later in life as his investments compounded over decades. If you followed his advice for 10 years, you would begin to see this effect clearly. At first, the growth feels slow, but over time, your returns begin generating their own returns. Your portfolio grows not just from new investments, but from the money already invested. This creates a snowball effect. The larger the snowball becomes, the faster it grows. The key lesson Buffett teaches is simple. Start early, stay invested, and allow time and compounding enough time to work their magic. After 10 years of following Warren Buffett's advice, the biggest change may not be your bank account. Your mindset would be different. You would no longer chase financial trends or panic during market swings. Instead, you would understand that wealth is built slowly through discipline and patience. Your investments would represent years of consistent decisions rather than lucky guesses. While many people spend years jumping between strategies, you would have spent a decade quietly building assets. And the most important part is that 10 years is just the beginning. The habits you develop during that time can continue working for decades, turning steady investing into long-term financial independence. Buffett's strategy may look simple, but its true strength lies in long-term commitment. If Warren Buffett's strategy teaches us anything, it's that building wealth isn't about speed, it's about patience. The question isn't whether his advice works. The real question is, are you willing to follow it long enough to see the results? If you enjoyed this video, don't forget to like, subscribe, and check out the next video on the screen to learn more about smart investing strategies.